Good afternoon. It's my great pleasure to welcome you to this afternoon's AI discussion on whether we'll have a soft economic landing or whether we'll have another financial market crisis. And it's also my great pleasure to welcome our excellent panel of distinguished speakers. In the order in which they'll speak, there are Ayan Koze, who is Chief Economist at the Equitable Growth, Finance and Institutions Department at the World Bank. He'll be followed by Bill White, who is currently a Senior Fellow at the C.D. Howe Institute and was formerly Chairman of the Economic Development and Review Committee at the OECD. He was also a senior official at the Bank for International Settlements. He'll be followed by Brad Stetzer, who is a Senior Fellow at the Council on Foreign Relations and who was formerly a senior staff member in the US Treasury. And I'll follow them with some additional remarks. I'd also like to welcome my former colleague, Alex Pollack, who will moderate the discussion. Alex, who was at the AEI for many years, is now a senior fellow at the Mises Institute and is the co-author of the new book, Surprised Again, the COVID Crisis and the New Market Bubble. As background to this afternoon's discussion, I thought that might be useful to recall a number of factors that characterize today's world economic landscape. The first is that inflation has proved to be anything but a transitory phenomenon and now seems to be the main policy challenge through most of the world economy. Making this challenge all the more difficult is the fact that inflation reached a multi-decade high of between 9 and 10% in the United States, in Europe, and the United Kingdom. It did so as a result of supply-side shocks, as well as monetary and fiscal policy-induced economic overheating. The second is that following 2 years of ultra-easy monetary policy, the world's central banks have now become increasingly hawkish in the effort to restore inflation-fighting credibility. Not only have interest rates been raised aggressively, the world's central banks have now shifted from massive quantitative easing to quantitative tightening. They're also underlining that they have no intention to begin reducing interest rates until they see the clearest of signs that inflation is returning towards their inflation targets. One indication of this dramatic shift in monetary policy is that last year, the Federal Reserve increased interest rates at the fastest pace in the past 40 years. Another is that the Fed is now withdrawing market liquidity by not rolling over maturing bonds at the unprecedented pace of $95 billion a month, even at a time of considerable equity, housing, and credit market weakness. The European Central Bank, for its part, has announced that in March, it too will start reducing the size of its balance sheet by 15 billion euros a month. That could raise questions as who it will be covering the Italian government's large gross borrowing needs this year and at what interest rates. The third point that I'd mention is that two major parts of the world economy are being hit by serious supply-side shocks. The European economy is being pushed into recession by a Russian-induced energy shock. Meanwhile, Chinese economic growth has stalled in a major way as a result of the bursting of its property market bubble and the mishandling of the COVID crisis. This slowing could have serious implications for the emerging market economies. The last point that I'd mention is that world financial markets have slumped in response to the shift in monetary policy. Highlighting this point is the fact that last year, US equity prices lost more than 20% of their value at a time when bond prices were down by more than 10%, and exotic assets like cryptocurrency lost 70% in value. These declines have resulted in an estimated $30 trillion decline in global financial market wealth. Meanwhile, the world housing market boom appears to have come to an abrupt halt, and housing prices are now falling. Disturbing cracks appear to be emerging in the world's credit markets. Evergrande, along with 20 other Chinese property developers have defaulted on their loans. In the United Kingdom, the Bank of England had to intervene in the gilt market to keep the country's pension funds afloat. A wave of emerging market debt defaults have now begun, and most recently we've had the bankruptcy of FTX, a large cryptocurrency trading platform. It also hardly helps matters that later this summer, world financial markets could be shaken by a looming United States debt ceiling battle. Janet Yellen has indicated that Treasury measures might delay a US debt default till early June. Meanwhile, House Speaker Kevin McCarthy keeps insisting that Republican congressional majority will not raise the debt ceiling without a commitment to deep public spending cuts. All of this raises a number of questions about the world economic and financial market outlook. First, what are the chances that the world's central banks will succeed in sufficiently reducing inflation without precipitating a recession versus the chances of a recession or financial market crisis or both? Second, what are the prospects for an orderly deflation of the world asset price and credit market bubbles, and how much additional market value may be lost? Third, with the world drowning in debt after years of ultra-easy monetary policy, what are the risks of an emerging market debt crisis or another round of the Eurozone sovereign debt crisis? And last, in the event that we do have world economic and financial market crisis, might there be a correct policy response to deal with such a crisis without setting us up for another boom-bust economic cycle? So without further ado, I'll hand it over to Alex to start moderating our discussion and to get some answers to the questions I've raised. Over to you, Alex.
Thank you, Desmond. And thanks for organizing this most timely discussion with such a knowledgeable panel. Now, let me add my welcome to the distinguished members of the panel and to all of you who are joining us by Zoom today. What will be the outcome of the deflation of the everything bubble with a loss of $30 or $35 trillion in market value that people thought they had, including values in bonds, especially speculative stocks, sovereign debt, cryptocurrencies, and as Desmond said, now houses joining the deflation. And what will all this bring about? As interest rates have necessarily returned to historically normal levels. These aren't high interest rates, they're normal interest rates, but they seem high to those who got used to the suppressed interest rates near zero, and especially if they built leveraged investments based on the assumption that the suppressed interest rates would continue. An interesting and unprecedented element in our current situation is that central banks themselves are generating losses on their huge QE, now low-yielding investments, which are being financed with now much more expensive liabilities. For example, it appears that the Federal Reserve is now suffering losses of about $2 billion a week. Now that annualizes into $100 billion a year. So even the central banks are not immune to the stresses of the deflation of the everything bubble, which they themselves previously inflated. Does this matter to our risk assessment looking ahead? In general, will we have, as many hope, a soft landing? Or will we have a financial market crisis, as the title of the conference says? Or will we get a stiff recession, or both a serious recession and a financial crisis, or a mild recession, which might count as a pretty soft landing under the circumstances? The Wall Street Journal reported yesterday that in its poll of economists, 3/4 of them predicted that the Fed would not achieve a soft landing this year. As always, the financial future is marked by deep uncertainty and fundamental uncertainty. As Bill White would say, it's a complex adaptive system, not a deterministic mechanistic system. So that we might say, with the poet Robert Burns, but I backward cast my that's my on prospects drear, and forward, though I cannot see, I guess and fear. Are we guessing and fearing, or are we guessing and optimistic? Our expert panel will tell us. Each panelist will make opening remarks of from 12 to 15 minutes, and we'll give them a chance to respond to each other or to clarify points, and then we'll move to a general discussion, including questions from the audience. The members of the audience, you can email your questions to Beatrice.lee, that's L-E-E, Beatrice.lee@aei.org, or you can send them to #AskAEI Econ, E-C-O-N. After that discussion, which I'm sure will be lively and interesting, we'll adjourn not later than 3:45. Ayhan's going to start the presentations, and Ayhan, you have the floor.
Thank you, Alex, and thank you, Desmond, for organizing the event. Such a wonderful, platform to discuss these issues with Bill, Brett, and you too. What I would like to do, I'm going to provide a few remarks about our views with respect to direction of the global economy in the baseline, and how different types of shocks could lead to certain outcomes we are discussing today. The big challenge we are confronted by is that when you get to a turning point of a business cycle, it becomes much more difficult to forecast. That requires a significant level of humility when we talk about future growth prospects and financial risks. And I will try to stick to some broad observations. And whatever I discuss today, they reflect my own views, not the views of the World Bank and its board and any other affiliated entity. Now, just 3 quick messages I would like to convey today. The first one is that 2023 will witness the weakest growth performance outside global recessions of the past 3 decades. So in the baseline, this is a very difficult year, however you look at it. But that baseline does not imply a systemic financial crisis, and it does not imply a global recession. The second important observation is that there is significant uncertainty around this baseline, and that uncertainty comes with multiple downside risks that are interconnected. Finally, there is, of course, a significant anxiety about increases in interest rates and the possibility of inflation remaining persistent. If inflation remains persistent, interest rate increases become necessary. And those additional increases could trigger a sharp repricing of risk in global financial markets and result in a global recession. And that's what I would call a hard landing. So with that, let me talk about our forecast first, how we see the global economy this year. Now, global growth is going to slow down to 1.7%. 6 months ago, we thought that global growth will be around 3%. It is important to put this 1.7% in context. This is the 3rd lowest growth rate the global economy would experience over the past 3 decades. The only lower growth numbers global economy delivered were associated with the 2009 and 2020 global recession. I'm going to talk a little bit more about this global recession issue, but let me continue about the certain groups of countries we looked at advanced economies will slow significantly. When you have this type of slowdown from 2.5% to 0.5% we are expecting this year, you end up with a global recession. That's at least what happened during the past 2 decades. We are not expecting a recession in the United States for the year of 2023. In fact, our growth forecast for the US is around 0.5%. This does not necessarily mean that US will not have a recession. It might have a recession, 2 quarters or a 1 quarter contraction, but we think that the US will, for the entire year, deliver positive growth. In the euro area, we are expecting growth to be 0. So in both cases, in the US as well as in the case of euro area, we downgraded our growth forecast by about 2 percentage points relative to what we had last June. There is debate about whether these economies will have recessions or not. Whether they will have recessions in technical terms or not, they will feel as if they are experiencing recessions with these growth rates. In the case of US, the 0.5% we are forecasting is the weakest growth rate over the past 4 decades outside of official, basically, recessions the country experienced. In the case of emerging market developing economies, China is the critical, basically, engine. If China delivers the type of growth we are expecting, around 4.3%, then the growth will be stable relative to what we had last year. Outside of China, growth will slow down in emerging market developing economies significantly from 3.8% to 2.7%. Now, China's growth also important in the case of course, East Asia and Pacific region. We are expecting that region to deliver higher growth this year because of China's performance. Last year, China delivered one of the lowest growth rates in modern era, around 2.7%. This year, there is a possibility China will surprise on the upside, especially in the second half of the year, that can pull East Asian growth as well as global growth. Other than East Asia Pacific, there is no significant increase in growth in any other region. In fact, almost all regions we are expecting growth to basically decline this year. And for all regions, we downgraded our growth forecasts. Now, it is important to understand how synchronized the slowdown is. This year, relative to the 6 months ago we had our forecast, we downgraded growth forecast for 75% of countries. We downgraded growth forecast for almost all advanced economies and around 70% of emerging market developing economies. When you think about global economy, of course, you focus on, global financial conditions, global trade, and commodity market developments. In the context of financial conditions, I am going to make some remarks soon. But in the context of global trade, we are expecting much weaker trade performance this year. In fact, we downgraded our growth forecast from above 4 to around 1.6%. So it's going to be very difficult to generate growth relying on exports this year. Now, another important issue, of course, developments in commodity markets. Commodity prices did moderate over the past 3 months, and in some cases provided hope when you think about the euro area's needs for natural gas. Having said that, when you look at the prices of commodities, they are still above what we had prior to the pandemic. And that creates all types of challenges for different types of commodity importers. Another important variable, when you think about the possibility of a recession, is confidence. And when you look at the confidence numbers around the world, you see that these are very low in fact, close to the low levels of global financial crisis. And it's true for the US, Euro area, as well as China, as you see on the right. Now, as I mentioned, this rather somber baseline comes with multiple interconnected downside risks. I put these risks in three buckets. The first one, the risk related to inflation. Inflation we expect to come down this year relative to what we had last year. Last year, inflation was around annual level of 7.6 to 8%, depending on how you measure. This year, that number will go down to low fives. Will that be enough for the central bankers to slow down or start cutting interest rates? We don't think so. In fact, we are expecting higher monetary policy interest rates, but there is a possibility unanticipated monetary tightening above and beyond our expectations and financial market expectations can take place. When that happens, depending on the magnitude of interest rate increases, we might see financial stress in an environment we have record high debt. In the second bucket, there are a number of connected risks, geopolitical turmoil, of course, the intensification of challenges with the Russian invasion of Ukraine. With that, energy and food insecurity and volatility in commodity markets, and social tensions when you have high inflation, weak growth, and food insecurity. COVID-19 outbreaks still a risk if you have especially new variants. Beyond that, we have these climate-related disasters, fragmentation of global trade, and even weaker longer-term growth prospects. I'm going to focus on one specific risk associated with persistent inflation and higher interest rates. What we look at is that given the experience of the past 12 months and how interest rate expectations shifted upwards, as you see on the left. In January last year, people were expecting Euro area interest rates to be basically negative. In the United States, interest rate expectations were still below 2, all the way up to September of this year. Now, in the US, peak interest rate expectations around 5, and of course, in the Euro area, is around 3. Now, I mentioned the inflation coming down. This is true if you look at the survey-based inflation expectations. It is true if you undertake econometric models. It is true if you look at the synchronized decline in inflation around the world. Having said that, this changes in interest rates this year, as Desmond mentioned, the fastest tightening of monetary policy, at least in the US over the past 4 decades, translated into larger sovereign spreads, higher sovereign spreads, especially countries that are importing commodities and they have weaker credit ratings. So what happens if interest rates increase further than what financial markets are expecting? So the policy interest rates around the world nowadays slightly below 5%. There's a possibility if inflation, even if it comes down, gets stuck at a point and becomes sticky, at that point, central banks, especially major central banks, continue raising interest rates. In one downside scenario we looked at, we increase the policy interest rates 100 basis points. When that happens, real interest rates turn positive for the first time after a long time and go up around 1%. That will push down global growth from 1.7% to around 0.6%. And of course, that means per capita global GDP contracting, and that's the technical definition of a global recession. When that type of outcome happens, you also feel financial stress along with a generalized collapse in confidence. There are a number of low-income countries, frontier market economies, already struggling with elevated debt levels. Some of them are, of course, in the common framework. Those types of crises will increase in the number and the magnitude in an environment you have higher than expected peak policy rates. Now, if this type of outcome takes place, advanced economies will, as a group, end up having a recession for the entire 2023 by about 0.5% contraction. In emerging market developing economies, growth will slow down all the way to 2%. So however you look at it, this would be a global recession with significant consequences in terms of real activity, as well as, of course, financial market performance. Will it be the repeat of the early 80s type string of financial crisis? That has to be seen. We do not see a major emerging market economy having the type of systemic financial problem, but we do see serious challenges in low-income countries and frontier markets. Let me conclude with a quick summary of what I said. This year will be a difficult year. We are expecting, as I said, one of the weakest growth performance of the past 3 decades. There are significant downside risks around the baseline we have. That baseline does not imply a hard landing in the sense of a global recession. There is a possibility a global recession could take place if we see higher interest rates than what markets are expecting. Let me conclude with one observation. Because of these overlapping crises, we have been producing a large number of studies. I invite all of you to check it. And we, of course, released the Global Economic Prospects report last week that has the details of what I presented today. Thank you. Back to you, Alex.
Thank you very much, Ayhan. And that takes us to Bill White. Bill, I think you're out. You need to unmute yourself. There
Thank you. May I begin by thanking Desmond for organizing this. And I often feel that I have a very dark view of the world. And it's only by coming on to panels like this with Desmond and Alex that I realize I'm actually somewhere in the middle. So I thank them for that as well. Next slide, please. Let me start off. Our topic is soft landing in financial market crisis. Let me start off by some reasons to be concerned about financial instability. Why are we talking about this stuff in the first place? Let me go from some broader points to some more specific ones about why we should be concerned. First point I want to make is almost sort of an epistemological point. An economy is a complex adaptive system. Most of the models and most of the frameworks that people use to analyze the economy tend to be sort of linear, deterministic. The economy is like a machine. It's understandable, it's controllable. I don't buy into that. I think the economy is much more like a forest, an evolving thing. And the thing about in the jargon, it's a complex adaptive system. And the thing about those kinds of systems is that, and they're well studied in nature and in society. The thing about those systems is that they often have tipping points, and so that they can be stable for long periods of time, and then all of a sudden they become unstable. So if you believe that, there are grounds for believing that maybe the financial system suffers from that possibility. Why would we think that they might be vulnerable? My second point is that we've had decades, literally decades of easy money that have encouraged risk-taking, particularly financial risk-taking. And you go back, you look at the Greenspan put, I think, in 1987, which has been continued over and over again. You look at the way in which monetary policy has responded to every kind of downturn or an incipient downturn since the 1990s. Always been the same. It's been easy money, and that's encouraged people to take on more risks. And when you look, getting more specifically now to actual explicit things that you can measure about that seem to indicate a prospect for financial instability. There are just so many of them. I mean, the mention was made just a moment ago about record high debt ratios, the IIF numbers, just for example, global debt ratio, that's the ratio of sovereign debt plus corporate debt and household debt. 2008 was 280% of GDP. By 2019, it was 321% of GDP. So if you thought the great financial crisis was a time of deleveraging, think again. And by the time the pandemic hit, it was, or after the pandemic hit and the governments had done what they did, we're up to 360%. So record high debt ratios. The debt is of decreasing quality. If you look at the credit ratings, you know, there's been a migration down from A to B to triple B. You look at the loans, the proportion of loans now that are covenant light has just gone up and up. The everything asset bubble, we've had a number of presentations here at the AEI on the everything asset bubble. The only point that and we all know the prices have been very high for equity, for corporate spreads have been very, very low. Bond prices have been very high. We know that there's been a retreat in the last little while, but there's still the prospects for more to come. A lot of worries right at the moment about household properties, about corporate properties. But the thing I want to add to about the everything asset bubble, it's got very narrow foundations. And the McKinsey Global Institute has just done a terrific recent study where they look at the total of all real and financial assets in 18 countries, I think, comprising 80% of global production. And 7% of all of the things that we measure as being assets, okay, 7% of them are real things like infrastructure, buildings, real capital investment. So we have a huge inverted pyramid here of assets resting on this very, very small base of productive assets, which I think is very important. I worry about the stability of financial firms and the loss of transparency. I know that there has been a huge increase in capital at banks. But one of the things that's happened in recent years has been a massive migration out of banks as lenders into markets and into non-bank financial intermediaries. And these things are essentially non-regulated and highly non-transparent. And Ken Rogoff just said yesterday at Davos that his principal worry is a degree of leverage and non-transparency in those areas that will lead us to a lot of trouble. Then we have the malfunctioning of financial markets, including the US Treasuries. Liquidity has been going down and down in many markets. We've had flash crashes. We've had anomalies where arbitrage doesn't work the way it should. And then lastly, low investment, low productivity, huge resource misallocations. Think back to Hayek and malinvestments. That's what you get when you've got too easy credit. And zombies, of course, that have been kept alive by banks and others, firms that have never made profits and probably never will. So are there reasons to be concerned about financial instability? There certainly are. Let me, since I'm talking about complex adaptive systems, let me refer back to Don Rumsfeld. You remember his great line? There are things we know, things we know we don't know, and things that we don't know we don't know. Well, let me use that as a kind of organizing framework, okay? What do we know? Well, the first point I'd make is that in complex adaptive systems, forecasting is essentially impossible, okay? Stress points can be identified, and I'm going to turn to this almost immediately. Stress points can be identified, but getting the timing of when those stress points will materialize into crisis is essentially impossible. Now, in terms of identifying stress points, one thing that has been mentioned, I mentioned it, and Mr. Coase mentioned it earlier on, debt is dangerous. Debt increases vulnerability in both good times and bad. And what I mean by that is that if you've got high debts, in good times, what happens is that the interest rates go up and you have more debt service to deal with. But in bad times, your revenues go down and we have a problem from a different source. Now, the good news in a sense is that I think near-term inflation has peaked. The bad news in a sense is financial exuberance has returned. Now, Desmond mentioned earlier on that we had a big shakeout in 2022. But in the last few weeks, in the light of this belief that near-term inflation has peaked, bond markets the rates are off, the equity prices are back up, Bitcoin's doing well. Now, what does all this mean? There's a presumption either of immaculate disinflation on the part of the markets or higher inflation tolerance. Now, the point I want to go on to in my next slide is what do we know that we don't know? Well, we know that inflation may have peaked, but we certainly don't know that it's going to go down to 2% without a recession. And my own view is that as we think about supply side shocks and that sort of thing going forward, I think the markets are underestimating the number and magnitude of the negative supply shocks coming down the road and also the positive demand shocks. And I won't dwell on this with any sort of degree, but I would just point out that we've had a big recession. They all have hysteretic effects. Okay? They reduce supply potential. Commodity prices were rising well before the pandemic, and I think will continue to do so. Climate change is going to be enormously costly going forward. Demographics, it was announced today, China's population is going down. The working age population in many, many places is down. And you add to all of that, and now we're talking decoupling, deglobalization. All of these things are negative supply side shocks that will push up prices. And when you think about the character of many of those shocks, they actually invite more investment in order to compensate for the negative supply side shock. And so if you put together negative supply side shock, positive demand shock, it's not impossible that we're going to have an environment of both higher inflation and higher real interest rates. We don't know if an inflation is back, please. We don't know if inflation is needed. If a recession is needed, whether it's already baked in. Now, we just heard in the last presentation, maybe so, maybe not. Or will monetary policy have to tighten more than now expected? My own personal view is I think we probably will have a recession and we will have high rates because the recession will not be adequate to bring us back to where we really want to go. And that's the worst case for a highly indebted world. You've got both recession and high rates, which could lead to a cumulative downward kind of movement. So next slide, please. What do we don't know? We don't know. Well, by definition, we don't know. But to say that you don't know specifically what other unexpected bad things might happen doesn't mean they won't happen. And we've got huge amounts of historical evidence of really bad things happening that people were totally unexpecting. And if good shocks are great, the bad ones make a bad situation even worse. And I will only make the point briefly that the private sector may now be focused on resilience in the face of bad shocks like supply side chains, et cetera. The public sector doesn't seem to have any kind of excess at all in terms of buffers to deal with those possibilities. So I think that we're going to need, next slide, please. I think we're going to need either more monetary restraint or longer monetary restraint. But I think there's two good reasons that will mitigate against that happening. And the first one is financial dominance. I think people rightly fear, central banks rightly fear that if they tighten up more than people currently expect, that you will get a big fallout, and in the end, you will have deflation. And I think, again, that there's a greater likelihood that the central banks will back off from that risk. There has been, particularly in the United States, a much greater fear of deflation than there has been of inflation, and the bias is in the direction of leaning against the deflation as opposed to the inflation. And as we just noted, the UK gilts debacle raises really serious questions, because the Bank of England was intent on quantitative tightening, and then you had a financial problem that meant they had to have quantitative easing instead. That raises some very fundamental questions. Second problem is fiscal dominance. People are reluctant to raise rates because government debts are already so stretched that higher government finances might make them essentially unsustainable. And if market confidence were to fail, you have a situation where higher interest rates are supposed to be disinflationary, but the higher interest rates force governments who don't want to pay the higher interest rates to go back into the central banks. And we've seen this over the course of the last 2 or 3 years. And so what people observe is that as the government debts are going up, they're all being financed by the central bank. And this immediately unsticks inflationary expectations. So tightening, when the government's fiscal position is poor, can actually lead to higher inflationary expectations. But a failure to raise rates, can lead to exactly the same conclusion. So this is not a place where you really want to be. And Japan, this has been all over the front pages the last few days. Kuroda's decision to, first of all, to widen the band, and then more recently to hold the band. We should be watching that very carefully, because that's going to be a really significant test case of whether what they do unsticks inflationary expectations or not. So next slide, please. And the next and last slide. So we're in a difficult situation. There's a best way out, which I guess the economists would point to, and there's a more likely way out, which I think the political scientists are more likely to point to. The best way out is orderly debt restructuring and fiscal restraint. One of the problems, and orderly debt restructuring, we've got very little appetite for it, and the administrative procedures are totally inadequate. On fiscal restraint, one of the complications there is that much of the increased investment that I talked about earlier on to deal with climate change or the absence of workers, you have to use capital to replace workers. If you need more investment, so in that sense, demand has to go up while supply is going down. There's only one thing that you need to square the circle, and that's lower consumption. It's the only thing that makes it all add up. That is going to be extremely hard to sell, both to the consumers and to the politicians. And that leads me on to the more likely way out. And I think the more likely way out is that people will continue to do what they're doing at the moment, which is basically just continue to spend and print. And the worry, as I've suggested, is that if what we've already done leads to dangers of either debt deflation, because the private sector indebtedness overwhelms them, or to very high inflation because the public sector indebtedness leads them to print and print and print. How do we avoid that? Well, I think one thing that could happen is that governments will turn to financial repression to control rates. This is something that happened after World War II. You remember the Treasury Accord, and the UK had something very, very similar. The rates were pegged at very low levels. There were capital controls. There were administrative and regulatory controls to force people to hold government debt. It worked after World War II, and there's quite a literature to describe how it worked. But the question is, could it work today? Given that we've got free capital movements and very, very few administrative and regulative procedures, particularly for non-banks. And if it doesn't work, then we're back to debt deflation or very high inflation or both. So as you can see, I am not very optimistic about the future. But as I said right at the beginning of my presentation, I am hoping that either Desmond or Alex Pollock will be more optimistic and redress the balance.
Thank you very much, Bill, for the cheery presentation. And I particularly note in a lot you said the importance of politics to the equation cannot be overstated, and that's one of the things that makes it very hard to forecast with any accuracy, since it's hard to forecast the political reactions. Anyway, thanks very much, and we will go on to Brad.
Well, I also want to join Bill in thanking Desmond and Alex for the invitation to speak here today. I did spend roughly 5 years of my life sitting across from Nouriel Roubini, so I'm used to hearing prophecies of doom. But this is, over time, perhaps I become the relative optimist in this room. So I wanted to discuss and focus my remarks on the questions related to emerging market debt distress, and also take up the question of Italy's fiscal risk. And to start with, when discussing emerging markets, I share Ayhan's view that it really doesn't work to think of all emerging markets as facing the same set of risk. In fact, I would differentiate quite strongly between a very significant set of emerging markets, which have, from an external sustainability point of view, developed what are not quite perfect fortress balance sheets, but something that looks like a bit of a financial fortress, and thereby have increased their resilience quite substantially. And then another set of emerging markets that unfortunately have even worse external positions than it appears, as the bulk of their reserves are actually borrowed reserves, whether from their own banking system or from their strategic partners. And then I'll kind of wrap up by at least laying out a framework for how I think about Italy's risk, because Italy's debt stock is undeniably large, it's undeniably fragile, and it's undeniably runs some possibility of spiraling into a bad equilibrium. But first, I do think it is important to recognize that a very large number of emerging markets have converged around a balance sheet structure that does provide substantial insulation against external shocks. What is that balance sheet structure? It's broadly as follows. A number of large emerging economies hold very large quantities of foreign exchange reserves, and critically, they have more foreign exchange reserves than their government itself directly has external foreign currency debt. That gives the country a number of structural sources of resilience. Higher interest rates raise interest income for the reserves more quickly than the external interest payments on foreign currency bonds rise. The central bank, by holding more reserves than the government has debt, it remains in a position to lend foreign exchange to the rest of the economy, and can also sell insurance against large exchange rate moves with modest risk to itself because it is structurally long foreign currency. Brazil, for example, sold local currency settled derivatives that protected foreign investors and Brazilians from the risk of a further depreciation of the real. Because the central bank had a surplus position in foreign exchange, it could do so. And that helps buffer against shocks not only to your foreign currency borrowing costs, but can help mitigate some risk associated with foreign holdings of domestic currency debt. So this kind of fortress balance sheet is actually pretty common through the emerging world. China, for example, famously has $3 trillion in reserves, foreign exchange reserves. And if you look at the direct foreign currency debt of the government, its external foreign currency borrowing is something like $50 billion. Nothing. And if you delve further into China's external balance sheet, China's banking system now is structurally a lender to the world. It supplies foreign currency, both to global funding markets, but also through the policy banks to a bunch of not so healthy borrowers. Point being that the banking system in China is actually structurally a supplier of foreign currency liquidity. It's not a draw on the government's foreign currency liquidity. India, way more foreign currency reserves than the government has foreign currency debt. That isn't to say India doesn't have substantial vulnerabilities associated with its domestic fiscal debt, but India has been very calibrated and careful in its direct foreign currency borrowing. Thailand, source of the 1997 global financial or Asian financial crisis, also insane quantities of foreign exchange reserves, about 50% of its GDP, almost no external borrowing. Korea, Taiwan, I could go on. The bulk of the major economies across East Asia are simply not in a position where the government will quickly experience foreign currency debt distress. Brazil, also, government has more reserves through the central bank than the government of Brazil has external dollar and euro denominated debt. Now, foreigners do hold a lot of the local real denominated debt. Brazil, there's a substantial stock of that, and there are a set of risks associated with those local currency holdings. But it is fundamentally a more resilient balance sheet. And even when you add in the hidden debt of Petrobras, the big Brazilian state-owned enterprise, the government still emerges as long foreign currency. Mexico, almost the same situation. Central government, more reserves than the central government has debt. Now, Pemex has some real problems and has way more debt than it should, is a real potential source of distress if it doesn't have the backing of the government of Mexico. But there's substantial strength throughout the emerging world. And I think that's why emerging markets actually, after a kind of a panicky sell-off in the middle of last year, have rallied, because I think there is recognition that there is not an imminent risk of a generalized systemic debt distress throughout the emerging world. However, there are a host of fairly significant emerging economies that are now on very difficult trajectories and face significant risk of default, if not a probability of further distress, simply because of the tightening that has been observed so far in the global economy. Egypt is perhaps the most important of those countries. The government there does actually have more foreign currency external bonded debt than the central bank has reserves. And those reserves, by the way, are all borrowed from Egypt's neighbors. They're not the government's, the intrinsic resources of the Egyptian economy. Its dynamics around its both external and domestic debt are troubled, and it doesn't have the same sources of resilience that some of the other emerging economies face. Pakistan actually doesn't have very much foreign currency debt, but even though it has less than 10 billion in foreign currency debt, it still manages to have more foreign currency debt than the government has foreign currency reserves. And in Pakistan, as in Egypt, all those reserves are borrowed. Another, a government that is intrinsically in a very weak financial position, and that will have difficulty managing even the current constellation of rates. Turkey is a more complex case. The government's overall levels of debt are lower, but Turkey also has more foreign currency denominated bonds than it has of its own foreign currency denominated reserves if you net out the gold, which I don't think is all that usable. And if you recognize that 20 billion or so of Turkey's stated reserves are actually Qatari rial and the Emirati currency, because they're kind of swap lines that actually augment your reported reserves without actually giving you any real foreign currency. And Turkey's other reserves are almost all, or even more than all, borrowed from its domestic banking system. Turkey's shown remarkable resilience. It continues to get funding from its strategic friends. It manages to run current account deficits, even when you would not expect. And its banking system has survived negative real interest rates, but it is hardly in a robust position. To sum up, there's a very important set of significant emerging economies that are in distress, that run the real risk of default in this cycle. And of course, there's a set of low-income countries that have lost access to markets and are either already in default or on a trajectory towards default. What is the other big sovereign debt related risk in the global economy, setting aside the self-imposed possible risk that divided government and the debt ceiling create in the United States? The US could be the one country that defaults simply because of a political impasse, not because it lacks resources. Well, the obvious risk is Italy. 150% debt to GDP, substantially more than the rest of the large euro area economies, and a relatively elevated borrowing cost, a substantial premium over Germany. And of course, the ECB, like the Fed, is in a rate hike cycle. So borrowing costs, even for safe borrowers, are going up. And of course, Italy's borrowing costs rise commensurately. However, Italy does have a couple of important sources of strength. A trick question. Did Italy or Germany, on average, run a bigger primary surplus, a net of tax collections relative to non-interest expenditure between 2000 and 2019? The answer is quite clearly Italy ran the bigger primary surplus and averaged about 1.5% of GDP as a primary. Germany's surplus, famously austere Germany, averaged a primary surplus of about 1% of GDP. A 1.5% of GDP primary surplus and a 150% debt to GDP ratio broadly achieves stability and sustainability if borrowing costs are roughly equal to nominal growth rates. So what are the risks that Italy faces going forward? One is the risk that Italian growth wildly underperforms average growth in the euro area, and there's not enough nominal purchasing power to generate the tax revenue needed to support this level of debt. It's a real risk. Italy hasn't grown strongly for a long time. And it's a period of relative underperformance when the ECB is setting monetary policy for the overall region would risk a dangerous debt spiral. The other risk, obviously, is if borrowing costs are more than a percentage point or two above the euro area average. And that pulls up Italy's debt servicing costs into an unsustainable spiral and forces difficult policy decisions between some form of backing for Italy's borrowing to lower its borrowing costs and or a massive, extraordinarily large restructuring of Italian debt. Italy's average interest rate on his debt fell from about 4% in 2012 to like about 2% at its lows in 2020, 2021. That is heading back up. That fall was broadly the result of falling overall euro area interest rates rather than a major compression in spreads. I mean, obviously spreads were going up and they kind of came down, but it kind of balances out. Italy thus faces a bit of pressure simply from the ECB's tightening cycle, unquestionably. That will pull up average interest costs. And I think the key question is whether those average interest costs rise to, say, 3.5%, a high level, but one that's broadly in line with Italy's likely nominal performance, or whether average borrowing costs rise up to 4%, which at 150% debt to GDP produces, when it's fully reflected in all the debt stock, interest costs of 5-6% of GDP, real difficulties if Italy only runs its average primary surplus of the past 20 years, and would force very, very difficult policy choices. The good news is I think the Europeans have thought these issues through. This is one of the known knowns, Italy's debt trouble. That doesn't make it any more difficult, nor does it reduce, in my view, the importance of maintaining, and we probably disagree a little bit with this within the panel, maintaining within the European policy architecture mechanisms to prevent an unsustainable upward spiral in Italy's borrowing cost. I think I'll end there and let any further issues come up in discussion.
Thank you very much, Brad. And that brings us to Desmond.
Thank you, Alex. I'll just get my slide presentation up. I guess speaking last, much of the ground has been covered, but I would put things together in a different way from the other panelists. It's not that I disagree with much of what has been said, but it's just the way in which I'd synthesize it in a different way. And basically, the point that I'd make is I'm very much more in Nouriel Rubin, Ken Rogoff's camp, that it's very difficult to see how you're going to avoid a hard economic landing, how you're going to avoid a financial crisis. And I say that because I think that there are three things that are basically going on. The first is that the central banks are now involved in synchronized tightening that is sending up interest rates and causing recessionary conditions. And that's not very good for asset and credit markets. The second point I'd be making is that they're doing this tightening in a very dangerous situation. They're doing this tightening when the world is drowning in debt, and much of that debt has been loaned at interest rates that don't nearly compensate for the default risk. And the third is they're doing this at a time that we've still got frothy asset prices in the housing market and the equity markets. So when I put all of that together, what I'm saying is that central banks are creating a situation of high interest rates and recession, and that is really anathema to credit markets and to the asset markets. So I'll just illustrate these points with a couple of charts that will really bring it out. So as Alex mentioned earlier, that the world has got used to zero interest rates. And now what we've got is we've got a situation where the Federal Reserve is raising interest rates at the fastest rate that we've seen, in a tightening cycle other than the Volcker period. So that is the red line on the left. It's just showing that interest rates have gone up by 4.25 percentage points, in the space of something like 9 months, when markets are premised on low interest rates. We see that in the mortgage market, where it's most clear, that you've just seen the affordability of houses going down. This chart is just showing that housing costs have really doubled. So it's difficult to see how you avoid a decline in housing prices and stress in that area. Just in terms of the recession, what's been a very good indicator of recessions has been an inverted yield curve. You're seeing here that the yield curve is inverted in a big way. Normally, this is a leading indicator. There are plenty of other reasons why one would think one's going into recession. Monetary policy operates with lags. This is still coming out. We're seeing softness in the US economy already. So it's difficult to see how you avoid a recession. I mean, the one good thing is that on the inflation side, inflation really does seem to be coming off. This chart, from Jason Furman just says that if you measure the housing costs in the correct way, rather than the convoluted way that the Labor Department does, you're already getting into a position where the last 3 months core inflation is coming down to close to zero. So, you've got good news on the inflation side. So what I'm saying in terms of this recession and high interest rates, that's obviously not good for stocks. You've got an alternative now to investing away from the stock market. You get 4% on treasuries. It also really squeezes profitability. So this isn't really good for corporates. And in terms of debtors, needless to say, if you've got high interest rates and recession, that complicates the debt service payment. So I think that all of this occurring at a time that we've already got high debt is problematic. So just to repeat the point that Bill made, is you just compare where we were in 2012 to where we are right now. We've gone up by something like 50 points of GDP in terms of debt. So there's a huge amount of debt. If we had debt problems before, I don't see why we're not going to have them now in a recession and in with interest rates high. A point that the BIS makes, which I find even more scary, is that you've got a lot of what they call hidden debt, with foreign exchange swaps and the like. They're talking about $80 trillion of this debt. Once again, this is up from 40 trillion before. So there's just a huge amount of leverage in the system, and I think that gets tested when interest rates are high and when we've got a recession. I guess a point that Bill made, which I very much agree with, is that one really can't take comfort in the fact that the banks might be better capitalized or better regulated than they were in 2008, when the much of the credit is being intermediated through the shadow banking system. We've got as much as 50% of the credit, and this is highly unregulated. So we're going to find out a lot of the stresses there. It reminds me of what occurred in 1998 with long-term capital. Nobody paid attention, and then you found you had real problems in that sector of the economy, and that's what I think occurs this time around. This chart just shows that equity valuations, while they've come off, are still high by historic standards. This is the Schiller chart. It's basically showing you that we're well above the long-term average. So equities have got a lot further to fall. So just in terms of where I see likely problems, where you're going to get credit stresses, but I would just stress that the fact that you've got so much credit having been made, you've got so many markets that are poorly priced, that and you're going to have this in a synchronized way. So it's not just going to be that it's not that we just got one risk out there. We've got multiple risks, and the three that I see are, what Brad referred to is the Eurozone. You're looking at debt levels that are higher than they were in 2012. Greece is at the top, but Italy, like Brad mentioned, it's 150% of GDP. It used to be 130% at the time of the sovereign debt crisis. I'm not as sanguine as Brad seems to be about Italy, in that basically what's kept Italy afloat up to now is that through its quantitative easing program, the ECB was buying all of the net issuance of the Italian debt. Now we're moving into a situation where they're winding this down. So the ECB, through at least its regular process of quantitative easing, they're no longer going to be in the market for Italian debt. So we've got a question that there's $250 billion gross financing needs that the market is not going to take. And what we're already seeing is we're seeing significant spread widening. If you look at Italy's interest payments now, they're over 4%, and this isn't a country that's known for its stellar growth performance. So just the whole debt dynamics doesn't work out. Particularly if you go into a recession. So I don't see how you avoid a Eurozone debt crisis of one form or another. It's going to put the European Central Bank in a very awkward position at the time that they're supposed to be quantitative tightening. They're going to have to come out and bail out Italy once again. On China, I think that a point that I would make is that China has had a larger credit bubble than we had in the Japan or the United States. If you just look at this red line, China's credit has increased by more than 100% of GDP in a very short space of time. You compare it to the run-up, the green line is Japan, the run-up to their bubble. This makes that look like a picnic. It makes the United States in 2008 look like a picnic. So I'm not that convinced that China suddenly, once the COVID runs its course, that China goes back onto a rapid growth path. They've got a major problem in their property sector, and the same thing with emerging markets. I agree with Brad that some of the emerging markets are in reasonably good position, but if you take it overall, we've got very much higher debt than before. So putting it all together, I just see that with all of this debt out there, with bubbles now going into recession and high interest rates, these bubbles, I don't see how we avoid a financial crisis, if not within 2023, certainly within 2024, but something's going to give early. And what I mentioned in my opening remarks is it reminds me of what we saw in the run-up to the Lehman crisis. We saw one or two hedge funds go. We saw Bear Stearns go. This time around, instead of that, what we've had is we've had the Bank of England having to bail out the pension funds. We've had debt defaults, big debt defaults in China. We've had this FTX blow up. Last point, just to end on an optimistic note, is with my view of what's going on, I don't see that interest rates, the central banks, I think, are going to pivot at some point. Interest rates are going to come down. And with my view, if we have a deep recession, I don't see why we're not going to have a deflation problem again, like we had in 2008 and we had in 2020, that if you have these bubbles bursting, you go into a meaningful recession, at least in the short term, you're going to get inflationary pressures being the last of our problems. So I'll end that there, Alex.
Thank you very much, Desmond. As usual, highly interesting slides. I was taken by the one slide of where the Italian debt went, and there was, of course, such a big section going to the central bank, propping up Italy there, the blue section, and Spain. Meanwhile, the central banks are interesting. The Swiss central bank's buying U.S. stocks, and the American central bank made itself into the biggest mortgage investor in history. So the central bank balance sheets, in my view, are a very important part of all this story we're trying to figure out. Anyway, thank you all, a great panel. I want to go back through the panel in the same order that we did before. Ayhan, Bill, Brad, and Desmond. 2 or 3 minutes, 3 at the most, just to react to anything anybody else said, agreement or disagreement, or something in between. Or anything else that you want to add at this point. So, Ayhan?
Yeah, thank you, Alex. It's great to hear from Bill, Brad, and Desmond. Uh, Obviously, my baseline narrative is quite similar to what Brad said. When we think about emerging market developing economies, for that matter, advanced economies, we need to take into account heterogeneity. Country-specific circumstances differ quite a bit, and the type of financial stress we are discussing in the context of higher interest rates triggering a debt crisis episode, there is really no systemic emerging market economy out there that is confronted by that type of challenge. This does not mean that when you have weak growth, higher interest rates, you are going to escape cracks in the financial system. Ultimately, there are, especially in the case of advanced economies, limited information. When we think about non-financial intermediaries, and to me, that's actually the kind of the part of the financial system that brings the largest amount of risk above and beyond the banks. We have reasonably good idea, and I think we made quite a bit of progress since the global financial crisis, improving their balance sheets. Now, let me quickly talk about one issue. Really, Bill mentioned this investment weakness, and this is something we obviously monitor closely. Investment ultimately is the single most important driver when you think about global policy priorities. You might talk to different people what the priority is, and you might get different answers when it comes to, whether it is eliminating poverty, whether it is achieving higher growth, or some people might say addressing climate change is the single most important priority. The good news is that everyone agrees on one solution. You need to have sustained and robust investment growth if we are going to deliver meaningful progress in any of these policy priorities. And in that context, Bill mentioned we have a serious challenge with respect to investment growth, productivity growth as well. But when you look at the emerging market developing economies, investment growth has been weak for more than a decade. Then, of course, was dealt another blow by the pandemic. Prior to the pandemic, emerging market and developing economies experienced a decade-long investment growth slowdown. The average investment growth was about 10% over the 2000s. Then it declined to 5% over the 2010s. Then, of course, the pandemic came. And during the pandemic, investment contracted in 70% of emerging market developing economies. And looking ahead, prospects for investment growth are not much better. Investment growth over the 2023-24 is expected to average just about 3.5%. And this is half of the average we saw during the past 2 decades. Now, there is another important...
I'm going to have to remind you, you're about out of time now, Ayhan.
Okay. So this investment challenge is something critical when we think about these higher interest rates and tightening financing conditions, because prior to the pandemic, financing conditions were accommodating and emerging developing economies were not investing enough. Now, even tighter financial conditions, generating investment growth is going to be a challenge. Back to you, Alex.
Thank you. Bill, comments?
Yes, some comments really sparked by all three presentations. I'm talking about the forecast. I would just mention that one of the things that we didn't mention, or at least I didn't mention, was the prospective difficulties associated with the interaction between government debt and underlying derivatives positions in the financial markets. And I just note that the gilt-edged debacle in the United Kingdom, where it started off with a greater than expected increase in interest rates associated with the trust budget. And that increase was greater than what the Bank of England was using for their stress tests. And so what it revealed was that the liquidity being kept by these liability-driven investment funds was not adequate to meet margin requirements. And Larry Summers actually said at the time, he didn't think that problem was unique to the United Kingdom. Now, that specific problem might be unique, but the interaction between the underlying complexities in the financial system and an absence of confidence, I think it's sort of a big deal. Second point, we've talked about tightening, but I would just note, and this is consistent again with my complex adaptive, the adaptive system part. When we talk about quantitative tightening, that is something that is very likely to touch off some problems in terms of market functioning. And I think we should be very careful about that. And Raghu Rajan and Viralash Acharya have written a recent paper that points out that the banks had all that extra liquidity, okay, with the extra reserves. And of course, being adaptive, they moved to rent it out, to make promises to other people. And if we now try to say, well, we'll take the reserves away very quickly, and the banks still have need of them, we have a problem. So much for that. Brad, could you say a bit more about the dollar liabilities of Japanese corporations, particularly the property companies? Because a lot of people have been worried about that. And on Italy, I'll forget about Italy for a second. You talked only very briefly about the US debt ceiling problem. But what do you see as the possibility that if that happens, it might focus the attention of markets almost everywhere on the fact that the debt ratios now are very, very large, and the deficits in most instances are unusually large as well. And lastly, for Desmond, where's all this going to lead? Higher rates, recession, blah, blah. Will it lead to debt deflation? I think the answer is yes. But my real worry is that in the context of that debt deflation, where the government's deficits are getting bigger and bigger, there will be an inevitable recourse to the central bank. And when that happens, it's the Latin American solution. So the debt deflation can turn in a dime into something really much more inflationary and indeed even hyperinflationary.
Thank you, Bill. And you set up Brad well. Let me just say, when you talk about the creation of liquidity by the central banks investing and creating reserve, just imagine if instead of letting investments run off as they mature, you actually had selling out of these central bank portfolios, which I do not think will happen. But if you did, that would be extremely disruptive, I think. Anyway, Brad, comments from you.
Sure. I guess I'm not going to be able to avoid talking a bit about the debt ceiling scenarios. So I'll start there and then do a bit of a rant probably on the term non-bank financial institutions, which is, I think, a disservice to the English language and unhelpful analytically, and then conclude a little bit with a few additional thoughts on Italy. First, there are different scenarios for what happens if the U.S. runs up, if the extraordinary measures which provide a bit of flexibility are exhausted and the U.S. runs up against a hard debt ceiling constraint. But one possibility, I think this is why it is very hard for financial markets to price debt ceiling type risk, is that the result of hitting the debt ceiling is a very sharp fiscal contraction in the U.S. The U.S. essentially stops paying a subset of its bills, prioritizes debt payments. And if that happens, the fiscal consolidation, the loss of demand in the U.S. economy, the disinflationary impulse would all actually be good for long-term bonds. So it doesn't necessarily translate into a broad global bond market sell-off. Conversely, if the Treasury were to decide to prioritize, and because essentially a debt ceiling means the executive branch doesn't have the money to spend on all the things that Congress has authorized it to spend money on. So it forces impossible choices. And if the U.S. were instead to defer payment on some portion of its debt, likely by with an implicit expectation that Congress would eventually adjust the debt ceiling, and those missed payments would be made good, I think that runs the opposite risk of triggering an enormous reevaluation of all sovereign related risk, simply because you kind of not only do you have the kind of the set of risk of unexpected default when finances look good that emerged with Russia, when kind of out of the blue geopolitics meant a country with plenty of reserves and very little debt couldn't make payments. You would also have a situation where political risk lead to countries that have the ability to borrow nonetheless end up in default. And then I think markets would be enormously stressed and shocked. But it's the choices that the executive branch face in that circumstance are really quite diametrically opposed in their financial and implications. Second observation is I wish the term non-bank financial institutions was eliminated. I've spent a little bit of time looking at Japan. One set of non-bank financial institutions are what generally are known as life insurers. They do run risk. They're running risk because of their foreign currency swaps. I've written a lot about this. Their hedging generates funding risks that are a bit bank-like. But it is more helpful to talk about the risk-facing life insurers running a hedge foreign exchange book than to talk generically about non-bank financial institutions. Japan Post Bank makes heavy use of non-bank financial institutions called investment trusts. Those are just trusts that invest on behalf of Postbank and other Japanese regulated financial institutions. It's effectively bank lending, just done in a kind of more complex way. And then in other markets around the world, you have private credit funds, credit hedge funds, which by and large get leverage from the banking system. So if something bad happens, the private credit fund, the equity's wiped out and the banks end up with the loan. So it migrates back to the banking system, and it's ultimately a banking risk. There's the liability-driven investment hedging issues associated with the pensions, which are unique. But I think it is much, much, much more helpful to talk about specific risk associated with specific categories of institutions than to just throw, there's all this non-bank financial institutions out there. They're understandable. It just takes a bit of work.
I bet we all agree with you on that. And
okay, I don't get to argue with Desmond. I'm sorry.
Your time is up, but you you get 1 minute on Italy if you want to take it.
Sure. 2 quick points. It is no doubt the case that quantitative easing made Italy's life much, much, much easier. Italy benefited more than anyone else from the fall in long-term rates and the compression of spreads, and the fact that the ECB was taking government bonds onto its balance sheet and putting out European deposits. It was a good trade. The fall in private holdings, though, of Italian debt is not unique to Italy. The ECB was buying more bonds than anyone was issuing. Net private holdings were falling throughout the euro area. So I don't think that's per se the risk factor. I think the risk factor is we don't know who in the market is willing to hold an ever-rising stock of Italian claims at an interest rate that makes Italy viable. The second point is that 4% is a very difficult interest rate for Italy. It is made easier right now by 2 things. One, inflation is way above that, even in Italy. So the nominal debt to GDP dynamics aren't as dire as they would be with 4% nominal rates and Italy's more typical deflationary environment. And the second is that it takes time for the 4% marginal borrowing rate on a 10-year to feed through the debt stock. So the fiscal pressure from this relatively high rate will play out over time. And there are a set of options that Italy faces as that pressure materializes. So it need not be an immediate shock.
Being out of time, thank you very much, Brad. Desmond, a couple comments, and then we got to get to audience questions.
Yeah, I guess what worries me about the debt ceiling issue is, firstly, it's not that far away. We're talking about something like June and July, and I'm worried that that can trigger risk off in the markets. And if you get risk off and you get spreads blowing up, that can be trouble if you've got a lot of leverage, and that this can really be something that is a trigger that causes liquidity to dry up, spreads to blow out, and we get into difficult situations. Just in terms of on the debt ceiling issue, that what it seems to me is that there's no appetite now in the United States to engage in fiscal spending. So if we do go into recession with the Republican-controlled House, you're not going to get a fiscal response. So we're going to be back to the situation where the central bank is going to have to once again flood the market with liquidity to keep things afloat. We repeat the cycle before. I don't share Bill's pessimism about going towards hyperinflation in the short run, because I think we've just gone through an experience where we've had the central banks of the world, the United States, the balance sheet of the Fed increased by $4.5 trillion between 2020 and 2022. And, my recollection is that we didn't have an inflation problem for much of that period, and I think that we could get something similar occurring. I've just got a question, in terms of the emerging market. I agree with Brad that the foreign exchange position of many of these countries is better than before, but they might have other kind of issues, and I'm just thinking of a large country like Brazil, that you've got a real problem on fiscal sustainability, that, I would think that could trigger a crisis in that country, even if they've got a whole bunch of foreign exchange.
Okay, thank you, Desmond. I think we need to come to some of our questions from the audience, and thank you all for sending in questions. I'm going to just take them from the top and see how far we can get. From Bildaru Meladan says, how could the medium-term outlook be changed if the fragmentation deglobalization drivers accelerate and globalization goes even more into reverse, I guess is the point than we have already. Maybe, Ayhan, you want to take that one, maybe?
Yeah, thanks, Alex. As I mentioned, this is a significant risk. And to some extent, it has been already materializing, I would say, since the beginning of 2016, when we have this tariffs imposed on major economic powers on each other. And then with the pandemic, I think we saw not just the governments, the multinational companies realize that they cannot simply rely on a small number of suppliers for certain types of goods, especially medical goods. And now with the Russian invasion of Ukraine and recent developments in the context of Taiwan and China-related tensions. So there are many reasons to think about the supply chains getting shorter, supply chains shifting from one country to another, and basically the types of the drive for cross-border trade turning into a different form, at least not necessarily the cheapest supplier, but the most secure supplier in different senses. It could be basically an ally, or it could be just a country that could provide the goods or services, whatever those are, sensitive goods and services out there when there is an emergency. The big issue is that trade has been slowing, global trade. That was a challenge prior to the pandemic. That challenge is still with us. And in an environment, you lose trade as an engine of growth. In the medium term, there are significant consequences. I mentioned already weakness in investment that goes with weakness in trade. and the big challenge, I think, in the medium term to push potential growth up. There are multiple reasons why potential growth has been slowing, and fragmentation of global trade will add to those reasons. So we are very much worried about the consequences over the medium term. Back to you.
Thank you. Let me go to the next question from Rich Miller. Please discuss the risks from the potential end of the Bank of Japan's yield control for Japan and for the rest of the world. Who wants to take that up?
I'm happy to offer a few thoughts,
Okay,
since I
great,
just wrote a blog that touches on this topic. So I think there is a risk of overestimating the risk from the end of yield curve control in the following sense. Even if Japan ends yield curve control, Japanese yields on an unhedged basis will be below European and US yields. So the absolute incentive for investors willing to take a currency unhedged bet on investing in higher yielding securities abroad will remain. It won't go away. There's almost no scenario where Japanese rates go above US rates, almost no scenario where Japanese rates go above French rates. The second observation is that a lot of Japanese investors have invested on a currency hedged basis, and that currency hedge trade has already effectively reversed. It's a function of short-term borrowing cost in dollars or euros relative to the long-term yield you get on loans or bonds or anything like that. And with an inverted yield curve, that trade simply doesn't work. So Japanese investors, institutional investors, have already been selling 100 to 200 billion of foreign bonds a year. The market has accommodated that, and that unwind will continue almost independent of any change in yield curve control. What this does mean, though, is that Japan, which historically has been sort of a steady bid for global credit, for global duration, for bonds in general, has become a net seller. And there are some scenarios where that net selling accelerates. And you can imagine if there's some kind of analog to the UK pensions crisis, some domestic Japanese institution that has made an unwise bet on low for long Japanese yields and gets caught out on that levered bet, you can imagine some scenarios where you get an acceleration of these sales. But I tend to think the dominant scenario is just, in a sense, it's another form of global tightening. It impacts the world, but it impacts the world in the way Fed tightening impacts the US.
Okay, thanks, Brad. We have a question from Jane Johnson, and I think this one's for you, Bill. She says, are we now simply seeing the unintended consequences of the Fed's QE policy over a decade? And comments, by any measure, QE was revolutionary, implemented by an economist who was serious of the Great Depression and lasting well over its originally announced end. As Bill White asked, and here's the question, Bill, can QE ever be ended?
Well, I certainly hope so, but I guess my the first point that I would make is that one of the things that QE has done, of course, is it's effectively shortened the duration of the government debt. Yeah. And in the Japanese case and the European case, well, in all of the cases, it has made the government debt service much more susceptible to rising quickly should interest rates go up. And that, of course, is a real worry. The other point, I guess, that would be made is that both the Bank of England and others have been thinking about this, but certainly the Bank of England was committed to QE, and then for a limited period of time, at least, it had to do the very opposite. So instead of doing quantitative tightening, it was basically expanding its balance sheet, and that sort of, I think, created. Maybe Brad could comment perhaps more on this than I can, but this must have really thrown some doubt into people's minds about the coherence of the anti-inflationary effort that the central banks were intent upon pursuing, and whether, in fact, it would be ever possible to fight inflation because of the prospective damage that might get done on the financial side.
Yeah, thank you. This one, Desmond, you want to comment on that? And then I have a question for you.
No, it's just what I said before, is that if in the United States, they are denying themselves the fiscal policy instrument to deal with any downturn, if we do have a financial crisis and we do go into recession, what else is there? That we're going to have to go back to the quantitative tightening before we're going to be replaying this, because the correct response would be proper fiscal policy, very well targeted, that would get most bang for the buck. But if you're saying that you're not going to do that, the central bank's in the ridiculous position, it's watching a meltdown. What's it supposed to do? It'll pump money in. And I think that's, what we've seen on the Bank of England, we're soon going to see with the ECB, that'll want to be quantitative tightening to get inflation under control, but then it'll have Italy at risk of blowing up. So they'll somehow figure a way of pumping money into Italy. So, you'll have that contradiction. On the one hand, they wanted to tighten quantitatively to deal with inflation, but on the other hand, they've got to loosen because they've got a debt problem with Italy.
Crisis. Then we get to Bill White's scenario, which is the government debt is expanding, it's being monetized, and so the government's turned to financial repression to control financial instruments and force the holding of government debt at low rates, maybe. Let me come to this question from Mark Tenney, and it's our last one from the audience. Maybe, Desmond, you want to take the first stab at this? Did macro models predict the inflation we had, or the amount of increase by central banks in response?
I don't know whether they did or whether they didn't, but they should have, that there was no question, that how could you not get inflation, if you had the largest peacetime fiscal stimulus on record, coupled with the easiest monetary policy, that the central bank allowed the money supply to increase by 40% in 2 years, and they kept the interest rates at zero. How could you not get inflation? Forget about all of the supply side factors that were pushing the inflation up. Just from the demand side, I don't see how if one missed that inflation call, there's something wrong with your economic model.
Anybody else? And did macro models predict what happened?
Well, I just note that it's not the policy as such that figures into the models. I mean, the models predict on the basis of inflation as a function of wage inflation, productivity, et cetera, and unemployment. And if there were no big movements in those things, then there would be no prediction of the rising inflation. I'd say more generally, I mean, you just noted it, Alex, that one of the problems with the models is that, and the analytical frameworks, is that they have consistently for decades underestimated the importance of supply side shifts. And I think with globalization, China, Eastern Europe, and everybody coming into the global trading system, and add to that the baby boomers, we had profound disinflationary tendencies for many, many years that should have been allowed to play out because the prices wanted to go down in the light of the positive supply side shock. And in leaning against those things, I think central banks have created the deflationary problem that they were trying to avoid. And indeed, Paul Volcker in his autobiography says precisely the same thing, that the central banks, in trying to avoid a little deflation, have actually created the deflationary problem that I know that you're worried about.
It's a great example of
Maybe I'll chime in with a couple of counterintuitive thoughts, but they're top of the mind right now. One is that I'm actually not as convinced as Bill and the global consensus that China's entry into the global economy was initially a deflationary shock. It also was an enormous demand shock for a lot of commodities. So if you look at inflationary data, the period where China was really globalizing from 2002 to 2008, you actually don't see super low inflation. The super low inflation emerges after the global financial crisis, when there's a sustained shortfall of demand in the advanced economies. So I'm not as convinced on that front. And I think maybe the World Bank and the IMF at times have been a bit too orthodox in forecasting that fragmentation going forward, is necessarily going to happen across the board, but B, that it will always be inflationary. If you think of the impact of the subsidies that are being introduced around the world for semiconductors, that should be, at least in the first instance, actually a deflationary shock, because there's going to be such an the form that fragmentation is taking is a coordinated increase in subsidies that should lead to an excess of capacity in the first instance that will lower, not raise prices. So I think we just have to be a little more careful in asserting the direction of the pressure.
It's the problem we have, and we have another problem, which is we're out of time. But I want to take just a little bit of time, colleagues, to do a very quick survey of the panel at the end. A soft landing or something worse? Which is our forecast? Ion.
It is going to be a very difficult landing, very weak growth, but it will be a landing in the baseline. Yeah.
A hard soft landing.
Yep.
Bill.
I fear for the worst, but I hope for the best.
Brad.
I'm on the hard soft landing side, but the odds that it's a hard soft landing rather than a hard landing seem to have gone up with some of the recent improvement in inflation data and the fall in commodity prices.
Thank you. Desmond.
Yeah, I'm in the hard landing camp. And the reason, I think that this is important is that I think that the macroeconomic models, what they generally forget about is they forget about the financial system, and what they're overlooking is the huge amount of debt, the huge amount of leverage, so I don't see how this is going to end well.
Thank you all for an excellent discussion. And thank you to all the members of the audience who are with us by Zoom. And we are adjourned. Thanks all.
Good evening.